YouTube, what's going on? Appreciate y'all watching my videos. What's going on? What's going on? What's going on, YouTube? So, this video, I'm talking about, on this video, I'm going to be talking about the best retirement strategy for long-term income. I've been meaning to do this video for a while. Some type of video talking about a specific strategy on setting up your retirement plan. So if you're somebody and you got 10, 15, 20 years from retirement, this video is for you. So, like, I'm just gonna warn you. Okay, I'm just gonna warn you. All right, I'm not a financial analyst. I'm not an attorney. I'm not your CPA. But just take it as a grain of salt. I'm not giving you financial advice. I'm just putting the information out there to show you some techniques to set up a retirement plan. So, okay, so what I did was I went into chat and I asked chat to find me the top five the top five ETF funds out there. Top performing five, the top performing ETF funds out there. And so what I was looking for something that's got high growth, that's got a high rate of return, so I can get set up, I can set up some kind of a salary program, some kind of a long-term income program, in retirement. I don't know when y'all planning on retiring, but right now I'm looking at retiring somewhere around 60, 65. So I'm 40 years old right now. So I basically set this up right here. It says the assumptions, right? The assumptions are like the criteria. So if you invest $500 a month for 20 years, it doesn't include taxes or nothing like that. But whatever your tax rate is, that's what you pay your taxes on. But I wanted to compare the top five funds out there against other funds. And so when you pick a fund, you got to commit to it. You can't flip it and sell it and day trade it. You got to keep it forever and just keep buying more shares. And so the whole goal is just to buy shares and keep them forever. But with this strategy includes additional step. Once you get to the end and get the fund to the amount that you want it, you have to switch it over to a dividend fund. So that way the dividend funds will pay you a salary every month, every quarter, or every year. Because a growth fund, it doesn't pay you a salary. It doesn't pay you dividends. That's what you want. You want the dividends. But the problem is with dividend funds, they grow slow. They grow slow. They don't grow fast enough for you to accumulate enough growth to where it could pay you a salary. So you have to balance the growth with the dividend funds. And with this strategy right here, will basically set you up where you can have anywhere between $50, $60, $70, $80,000 a month. Not per month, but $60, $70, $80,000 a year in income. I know some of y'all, you probably like, man, that ain't no money, man. That ain't no money. But the problem is that when you get to 60, 65, 70 years old, say you 70 years old, you're not going to want to go to nobody's job. I mean, just keep it real. You're not going to want to go to nobody's job. You don't want to climb in no truck. You don't want to be doing Uber. You don't want to be doing things in old age where it's going to just make you do a lot of work. You don't want to be doing all that work. You don't want to do that. So, it would just make sense to go ahead and just save a little bit of money. And like the assumptions that I put in here is only $500 a month. And I get it. For some people, $500 a month could be a lot of money. I get it. But if you can spare $500 a month over the next 20 years, this program will set you up. This program will set you up real good. Okay, so let me stop running my mouth and get started with it. So, excuse me, this is live, okay? So, I didn't really take down any notes or anything like that. I'm just doing this live. But it'll get the job done. So if you look at this PDF right here, this was prepared in chat. I used Chat GPT to prepare this. So you use this information at your own risk. I'm not giving any financial advice, but take it with a grain of salt. Just general investing information. So what I did was I told Chat to research the top 5 ETFs. Okay. And so it came back with these 5 right here. Are these the top 5? I don't know. You might have to research on your own and double check to make sure that these are the actual top 5. But what I do like about these 5 is that the expense ratio is low. They're relatively low. They still pretty high, but they're relatively low. And so the expense ratio is the fees basically charged into the fund. A lot of times you really don't see the expense ratio. You don't get a bill in the mail. Okay, you're not gonna get a bill in the mail. But the expense ratio is the fee that the fund managers charge for the whole account. And so if you got 50,000, say you got $10,000 of QQQ right here. It charges a 0.15% expense ratio. And so basically on $10,000, that's basically $15 a year. And you might think, man, $15 a year ain't nothing. Yeah, $15 start to add up real quick. And, you know, it's a difference of like $100,000. It's a big difference after 20 years. You got to crunch the numbers. It's a big chunk of money. And so I don't know about you, but I don't want to spend $100,000 when I don't need to. And so that's kind of my whole thing with that. You know, most people, they don't care, but you better care because it adds up to a lot of money. That 0.15%, it adds up. And so when you got 500,000 and they charge you 0.15, you talking about a piece of change. You know, it's a big chunk of money, but it is what it is. All these funds charge some type of fee, and they all different fees. So that's why I included that in here. I asked chat to include a column for expense ratio and annual returns. Those are the two things I'm worried about. And then I have another one. I have another PDF that's talking about taxes. What is the effective tax at the end of this? Because sometimes a fund could perform better, rate of return. A fund could have a higher rate of return, but at the same time, the fund could have a lot of taxes behind it, and it may not be, it may not be advantageous for you to invest in it just because the tax is so high. So you got to consider the taxes and expense ratio. What is your net? What is your net? Just like running a truck. What is your net? What do you take home? It don't make sense to get a brand new truck when you can get a used truck and make the same money. And that's the same thing we saying here. It don't make sense to pay all them taxes and fees when we gonna end up at the same point in time with the same amount of money. And so you got to crunch the numbers, do the math. And so that's kind of what we're doing here. So we got 5 funds: QQQ, ACHG, IWF, SPYG, BYG, VUG. So you got a Vanguard, you got I think Spider State Street, iShares, you got Schwab, everybody knows Schwab, and then you got Investco. And so these are the companies that manage these funds. And you can go to the websites that actually own these funds, that run these funds. And so you can look at the different percentages right here. And so if you look here, it says 500 over 20 years. It pretty much shows you how much money you will have, or how much value, because you don't have the money yet, because the fund it's in equity. It's not cash. So if you look at year 5 for QQQ, if you look here at year 5, it's 47,000, right? And then at year 10, it's at 163,000. Year 15, 400,000. And then in year 20, you got 1.1 million in there. Okay? And then you got SCHG. The performance on that one is about 18%. And where it calculates, where it gets the percentage, it looks at the past 5 years. I think it looked at the past 5 or the past 10. So depending on what was the performance over the last 5 years, is using that average to come up with an average number. Me personally, I like to look at 10. I don't like 5 years. I don't care what the last year. I don't care what the last 2 years. I want to know what the last 10 to 15 years of average return, so I can kind of predict a little bit what the future return is going to be. Now the rule of thumb is, well, past returns is not an indicator of future returns. However, it's giving me an idea. It's giving me a range. I can get in a range of 2 to 3%, and what the future rate of return is going to be. So take that with a grain of salt. Okay, take that with a grain of salt. So like I was saying, ACHG is coming in at 18.58%, and at 5 years you're getting 47,000, and at year 10 you're getting 157, 15, 415, and then year 20 you right at $1 million. And IWF is about the same, and Spider, SPYG, is a little less than 900,000, 800,000 at 20 years. And so the thing is though, you want the fund that's gonna provide you the most amount of value, the most amount of money, the most amount of value at year 20, 25, or whatever point in time you want to retire. You want the most amount, the best performing stock out there. The best performing stock for your money, to be honest. So you basically, just say if we was gonna invest in QQQM, right, for 20 years, and we got 1.1 million. Let's see, okay. Well, I'm gonna come back to those. I'm gonna come back to that in a minute. I'm gonna come back to that. Well, you know what? Let me talk about that later. Let me talk about these momentum stocks, these ETFs. Talk about these momentum ETFs. Okay, so these funds right here, the growth ETFs, these ETFs are similar to the momentum ETFs, but the momentum ETFs, the criteria for a momentum ETF is much more is more strict. And so if you understand the criteria of those ETFs and how the fund is managed, how it's managed, it sets criteria based on the momentums. It sets the criteria based on price movement. So the faster a stock is moving, or I guess volume or price action, price activity, they classify it as a momentum stock or a momentum ETF. That means the price is raising so fast that in such a way it's supposed to create a higher rate of return. So a lot of people on the internet, they love the momentum stocks. They love momentum ETFs because they move so fast. The stock is moving so fast. It has a lot of price action. So if you do research on some of these momentum stocks, you will find out that, okay, there's certain strict criteria to be for stocks to be in the fund. If it's not, if it drops below a certain I say price speed or price average or whatever, it gets kicked out. And so basically that's how a lot of these ETFs run. That's how a lot of these, the mechanics of it, how it works. Most of these funds are passive. And so when the price drops below a certain dollar amount, or if the stock if the value of the stock drops below a certain amount, it's all kind of reasons that a stock may drop out of the fund for some reason. And so it's based on the criteria that's set up. And that's what makes the fund the fund. And so okay. Hold on, y'all. I made a mistake. Okay. All right. So these are momentum ETFs. All right. These are the momentum ETFs. As you can see, you got SPMO. SPMO supposed to be the best fund out here. I think this year SPMO its rate of return this year was like 24% rate of return this year. I would say one of the top 5 performing funds today, as far as the S&P 500. It's basically an S&P 500, but much more tighter. It's tighter. It has more heavy, tighter filtering criteria. So that's, because it's not a full-fledged S&P 500. It's a S&P 500, but it's a little tighter as far as the filtering, like I was saying before. So according to this, I think this chart here is this rate of return is 17.9. That's based on the average 5 years. It's based on the last 5 years. So it's not last year, but it's assuming based on 5-year average. So that's what that 17.9, and out of these four, it looks like it's the best performing one. And I'm not advising to go and invest in it. I'm just putting the information out there. So, if you want to go invest in it, you kind of see what you'll be looking at. So it looks like SPMO, like I was saying before, with a 17.9% average 5-year return at 20 years, you'll be looking at 900,000 at 20 years, which is, it's still decent, but it's not better than QQQ. It's not better than QQQ. It's not better than QQQ. And SPMO, it's got 0.13% expense ratio. So it's not too bad, but it's a little expensive in the fact that you're paying 0.13% for a fund that's only 17.9% rate of return, which I would buy ACHG, because ACHG, they only charge 0.04% rate of return, which you getting a higher rate of return, for less money. The fees are cheaper. So, if you ask me, I'll go with that. Or I would go with Spider. I would go with Spider or Vanguard. You paying for the rate of return, the cost to be in the fund is, the cost to be in the fund is cheaper, if you ask me. So but I did ask chat to go ahead and provide me the top 5 funds, the top 5 momentum funds, because momentum funds is worth talking about. They're the type of funds they're worth talking about, to be honest. So, like I was saying before, a strategy, the ultimate strategy for me is to build as much value as possible within the shortest amount of time. So if you somebody who got 10 years to retirement, 15 years to retirement, 20 years retirement, and you trying to set up a program where you can get about $60,000 a year. And if you got a retirement account, like if you set up your Roth IRA, and I'm not talking about a 401k at your job. I'm just saying, if you just manage this account on your own and you buy one of these funds, right? And you just invest in it every month, or you can do it every week, however you get paid. Just figure out amount of money you want to invest in. So, say you invest $500 a month. You invest in it, and you get to 20 years, and you got $1 million in there. So now you got $1 million. What do you do with the $1 million? Do you keep it in there? Do you swap it out? Do you go to the casino and spend it? Put $1 million on black? What do you do with it? And so this strategy I'm talking about, all you have to do is just buy a dividend fund. Because if you keep the money where it's at, you're not going to get any income off of it. Because I think I think a lot of times, a lot of guys don't understand that, okay, you buy S&P 500, but a S&P 500 doesn't pay a dividend. And if it does pay a dividend, it don't pay a good one. It only pays like a 0.5 or 1%, 2% dividend. That's not enough to live on. If you got $1 million and you get a 2% dividend off a fund or 1% dividend, that's only going to give you $10, $15, $20,000 a year off $1 million. And in order to get more money than that, you're going to have to sell some of your shares. And you don't want to share, you don't want to sell your shares. You don't want to sell the golden goose. You don't want to sell your rental property. You don't want to sell, you don't want to give up your, you don't want to have to sell it. You want to be able to keep it. And so that way it'll just continue giving you money. So what you're going to have to do, it's the whole point of this strategy, is to invest into a growth, an ultimate growth fund that's going to grow your money, compound the money, right? And then once you get all the money, you sell what you got, you sell everything what you got, and flip it over and put it into a dividend fund, so that the dividend fund, it pays a higher yields. And so, like I was saying at the beginning of the video, dividend funds don't grow as fast as an S&P 500. They don't grow as fast as an ultimate growth fund. So that's why you have to switch it out. You have to put it in a different gear, so to speak. So if you invest in QQQ for 20 years, or SPY, whatever fund you want to invest in, and you sitting at 60 years old, 62, 63, 65 years old, you've been investing for 20 years, and you got about $1 million, 1.1 million, 1.2 million, 1.5 million. You get that 1.5 million, you change gears, and then you go ahead and buy a dividend fund. So I asked chat to prepare a list of the top 5 dividend funds, and this is what it did. And so the title of these funds is dividend ETFs for income. We looking for income, cash flow. Remember my previous videos, I talked about cash flow. I don't care about stock prices. I don't care about, I buy and hold and keep it forever. Okay? You keep it forever so you can get right here at 60, 65 years old, when you got $1 million, you change gears and you can buy one of these funds right here that pay a 4.74% ratio, of 4.7% dividend ratio. At 4.7% on $1 million, that's $50,000 a year, easy. That's $50,000 a year, easy. Because at $1 million, you do $1 million times 4.74, that's just easy math. You just move the decimal point. Basically, you move the decimal point 1, 2, 3, 4. You move the decimal point 5 times to the right. Basically, that's your salary right there. 50, what is that? 50, 47, 4 on $1 million. $47,000 a year, based on what I'm seeing here. And then you pay a 0.07% expense ratio. I mean, on $1 million, what is that? Like, I don't know, $700. I mean, you move the decimal point 5 times, so you go 1, 2, 3, 4. Yeah, that's about probably about $700 or so. And so, if you ask me, you don't ever have to sell the shares. You don't, because if you turn around and buy $1 million of SPY, you buy $1 million of Spider right here, S&P 500 high dividend ETF. You buy this specific fund with $1 million. You don't ever have to sell the shares for money to pay the light bill. You don't ever have to sell the shares for money to put food in the refrigerator, to pay your car note, whatever you need at 65 years old. you have this, as long as you own this fund, it's gonna send you about $47,000 a year in dividends. That's what it's gonna pay you. That's what it's gonna pay you. And more than likely, that fund is invested in Chevron, because you can instead of putting $1 million into this fund, you can just go buy these stocks directly. You can just go directly and buy these stocks. You can buy all the top dividend paying stocks: Chevron, Exxon, Verizon, AT&T, Coca-Cola, Procter & Gamble, Johnson & Johnson, Kimberly-Clark, Colgate. I mean, I can go on and on. All the standard old companies that paying strong dividends for the last, I don't know, what, 50, 60, 70 years consistently. The dividend kings, basically. You know, the dividend aristocrats. And then you got this one right here, the iShares International Select Dividend. This one paying 4.49, you know. And then you go on and on and on. And so if you go down this list, I mean, this is basically, you know, if you look at my PDF here. These are basically estimates, but it's giving you an idea on what you're going to be looking at if you save $1 million. And it don't take much. And I told y'all, and all you have to do is just save $500 a month in one of these top performing ETFs. You got QQQ, ACHG, IWF. I mean, it's a bunch of different funds out here. But me personally, I want the fund that's going to pay the most rate of return. And at the same time, I want to balance that rate of return with cost. Because there are some ETFs out there that charge straight out 1% expense ratio, 1%, 2% expense ratio. It's very, very expensive. You know, and so you got to be careful. You got to keep a balance between rate of return and how much are you paying for that rate of return. You don't want to pay too much. You want to keep the price, keep the cost down. Just like I was saying, I kind of use an analogy like trucking. I know a lot of y'all in the trucking business. So, you know, a lot of y'all in the trucking business. So it's the same thing as buying a used truck and a new truck. It's the same thing. You can go and get a truck and trailer, a used truck and trailer for $20,000 and make the same amount of money you go and buy a brand new truck and trailer. Why buy a brand new truck and trailer when you can just buy a used one and make the same money? And so it's the same thing. Why pay more expense ratio when you don't need to, when you're gonna make the same rate of return? So you gotta, when you're doing the research, a lot of these ETFs and these index funds and all that, make sure that the price that you're paying for that rate of return isn't too much. You know, you don't want to pay too much for it, because once you buy it, you got to own it and stay consistent with it and keep it forever. You can't sell it. I wouldn't you. And so if that's the case, that means you got to do the research. You got to narrow it down to the top 5 and compare the top 5 and weed each one out and figure out which one. And I know, like for me, I've been investing in QQQ for about 5 years now. I love my performance in QQQ. You know, I would say the performance of QQQ is probably double. I probably doubled my money. And so I'm really proud of the performance of the QQQ that I have. So I'm not advising to buy QQ, but I'm just saying, you know. So basically this is a chart, okay? And these are income estimates. These are not like confirmed or anything. These are just estimates. Anytime you kind of predicting the future with money, it's kind of an estimate, but you want to come in relatively close to give you an idea on what the next 5, 10, 15, 20 years is going to look like. So if you look here, basically what I was talking about, look, QQQ with $1 million, 1.1 million, if you invested in a Spider at year 20. So basically, if you don't understand, if you lost, you understand. Let me explain it to you. You're investing for any amount of time, either be 20. On this chart, I just used 20 years because I'm 40 years old and I got about 20 years more to work. And so I want to retire by age 60, 61, 62, somewhere in there. That's where I want to retire. So if I have a goal to retire at a certain age, and I use 20 for this one. So if you put in $500 a month for 20 years, now mind you, let me explain something to you. $500 a month compared to this million is not a lot of money. You may thinking it's a lot of money because that's your money, and you may have some personal bias and feeling some type of way, but what you getting in return, you talking about $1 million. I'm just telling you, we're having $1 million conversation on this live. And if you're not doing this, I don't know what you're doing, because at minimum, you need to be doing one of these funds. One of them. If you do any one of these, you're going to be good. Okay? So let me just say that. Because I talk to people, and I talk to them, and they be like, man, I don't have money to invest. I was like, man, I'm sitting here talking to you. I'm like, man, you crazy, because we're having $1 million conversation. Because you putting $500 a month for the next 20 years, you only putting in $120,000. Do the math. I'll wait. Get your calculator out. Multiply 500 times 12. That's going to give you about $6,000, right? 6,000 times 20. Okay, 6,000 times 20. That's going to give you $120,000. Okay? Think about that. I think I really need y'all to think about that. You only putting in $120,000 of your own money over 20 years, and you get back $1 million. If you do the math, the rate of return on that is ridiculous. That's like what is that? That's like a 500% rate of return, man. Remember my previous video when I tried to explain to y'all what the compound formula is? Remember when in my last video, a couple videos ago, I tried to explain that to y'all? I know some of y'all just can't understand it. You can't even wrap your head around it. I don't know, man. That's just math. It's just math. I can't explain math. Math is math. And so, let me just tell you, if you're not just doing one of these funds, I don't know what else you're doing. We're having $1 million conversation. We're having an $800,000 conversation at minimum. $700,000 to $800,000. If I'm wrong, we still having a $700,000 to $800,000 conversation. But anyway, so if you invest in QQQM, you have $1 million, 1.1 million. You take that 1.1 million and you invest it in Spider at 4.74%. That'll give you $53,000 a year. So these amounts under the tickers, those are annual incomes off of dividends. That's dividend income. So on Spider, so if you take this money and you sell off all your shares, SCHG, for $1 million, and then buy SPY, you will be getting $48,000 a year, and so on and so on. And so it looks like to me the best rate of return is QQQM. QQQ and QQQM they're the same funds. They're basically the same funds. One is just cheaper than the other. They're the same funds. So when you start doing your research and you be like, man, what 404 talking about? 404 QQQM and QQQ, what's the difference? The only difference is QQQM is just cheaper. They charge a cheaper expense ratio. It's the same criteria, the same stocks, pretty much the same fund. It's just a cheaper fund. They don't charge as high as an expense ratio as QQQ. And so if you can see here, it seems like the best one is 53,000. The best one here is QQQM. I mean, you can go through all these other ones, but I mean, it ain't really no point. And then I asked chat to do a momentum comparison. I wanted to see, what the momentum stocks do. We already decided, but just because QQQM gives a higher rate of return, you're going to have more money. You're going to have more money at the end. So it's best to invest in the stock that's going to give you more money, or the best ETF that's going to give you more money. So SPMO, after 20 years, and these are estimates, because I asked chat to do a historical analysis so that I can get an idea what the rate of return is going to be. I mean, 20 years haven't come yet, so we really don't know. But we got enough information to make a good, educated guess, okay? We got enough information here so we can make good, educated guess. And so, like I keep telling y'all, I'm not a financial advisor. Take it with a grain of salt. It's all on you. That's a disclosure. It's all on you. But based on this information, I have no choice but to move forward based on the numbers that's in front of me. So if you look, SPMO, out of, because these are the top 5 momentum stocks. So I just wanted to see what the momentum stocks. I'm surprised that the momentum ETFs are as low as they are, because usually momentum ETFs are usually the best, because of the filters that they have set up. They're so tight. So and so if we scroll down and look at the little notes with this guy here, it said if the balance is $1 million with 4% yield, we're looking at about $40,000 a year. And if the balance is 1.2 on a 4% yield, I mean, we looking at $50,000 a year. It's just that easy. But the thing is, you got to get the value up. So that means you have to invest in high growth funds. And so that's the thing. You have to invest in high growth funds. Okay, so now let me check. Let me see if there are any questions. Okay. Okay. PRDGX sent 700 in dividends to my 401k December. Hold on, y'all. Okay, how do you get the... y'all. I'm trying to get the questions to show up. Okay. Hold on, y'all. Hold on, y'all. I'm trying to figure out how to get these questions. Oh, all right. Let me go into the expenses and taxes. All right, let me talk about the expenses and taxes. I don't want to make this video too long. Where we at? Oh man, we're already at 45 minutes. All right, let me talk about these taxes and fees. So this PDF right here, this PDF basically goes in and talks about what kind of impact does the expense ratio and taxes have on because I'm worried about is having net income. That's all I care about. That's all I care about. Because at the end of the day, the whole point of us saving all this money is to have cash. To have cash. So the whole thing is to have cash when it's all said and done, is to have cash. We paid our taxes, we done paid a bunch of fees. What do I take to the bank? So if you look, it looks like QQQ, even when you take an account for fees and taxes, it's still the best one on here. It's still the best one on here. That's what it looks like. So to the most powerful thing that you can do in this situation, you buy an ETF or an index fund, the highest return ETF, the highest return ETF, the highest ETF that the ETF that provides the highest rate of return with the lowest cost. You buy it in a Roth IRA. That's the best way to do it. I know, like with me, I got some of my stuff in the Roth IRA, and then I have some in a regular brokerage account, in a taxable account. Because the thing is, you don't pay taxes in a taxable account. You don't pay taxes until you sell the shares. So you got to make damn sure you want to keep this fund. You got to do the research and make damn sure that you gonna keep it for a very long time. You know, my mantra is keep it forever. Keep it forever. But I mean, realistically, you can't keep it forever, because at some point you're gonna need the money. You're gonna have to pay bills with it. You're gonna have to go to the doctor and all these other things. You have to do life. And so that's the whole point of all this. We need to invest and grow some wealth. And so I don't want to go down that rant, but the point is, we have to be mindful of taxes and fees. And so the best way to do this, in my opinion, is to buy this funds in a Roth IRA. Because if you buy it in a Roth IRA, the fund will grow tax-free. And so I just did the math right here in front of you. Okay, let me get my calculator. My calculator. Okay, let me do this calculator. So $500 a month times 12. I done did these numbers so many times. 6,000 times 20. You invest $6,000 a year times 20 years. That's 120,000. So the thing is, the best thing for you to do is buy this fund in a Roth IRA. You buy it in a Roth IRA knowing that you don't need the money right now. You got to make damn sure you don't need this money right now. $500 a month, y'all can spare $500 a month. That ain't but $100 a week, man. Come on now. $100 a week. What are we talking about? If your life is that doggone tight, you can't spare $100 a week, turn off my video. You got to go get you some more money. You got to address your income. Turn this video off. I'm talking to guys who got extra money and they don't know what to do with it. And we ain't talking about a bunch of money. I'm just going to be real with you. We're not talking about a bunch of money. If you really think $100 is a whole bunch of money and you like, man, I can't afford it. I can't afford $100 a week. You really need to turn my video off and address the core issue. You need to go and address those core issues. You need to go and address that. You really need to go and address your career. You need to get your money up. You need to get your skills up and then come back to this video. You need to watch some career videos. You don't need to be watching this with no money. Because we ain't talking about a bunch of money. I'm not trying to pick on nobody, but we're having a graduated conversation here. We're having a graduated conversation here. You're not here yet. You're not up here yet. If you can't afford $500 a month, God's sake, I'm talking about $500 a month, $100 a week. And I'm not trying to pick on nobody, but I'm just calling it what it is. You're a grown man and you can't, grown man or woman watching my video, and I'm talking about investing. I'm talking about growing $1 million and you can't afford $500 a month. Come on now. I'm just being real. So let me get off that soapbox. But what I'm saying here is, I need y'all to understand $120,000 can grow to $1 million. Let that sink into your mind. Let it sink in. Let it sink in. Think about it. 100,000 to $1 million. Think about it. We're having $1 million conversation here. That's all I'm saying. We are having $1 million conversation. I think you need to stay on this video for a while. Okay? So now, if you put this fund, open up a Roth IRA, I don't care where you go, Robinhood, Charles Schwab, Fidelity, T. Rowe Price, I don't care where you go. You open up a Roth IRA. The reason why you need a Roth IRA, because I just showed y'all the whole chart, all the numbers. I just showed y'all. This $120,000 can grow to 1.1, almost 1.2 million. When you get ready to pull it out, it's tax-free. Because if you leave it any other account, a regular brokerage account, anytime you move it or sell it or do something with it, you're going to have to pay taxes on it. You're going to have to pay capital gains on it. You don't want to be messing around with the IRS. You don't want to be messing around with them. Because then if you start messing around with the IRS, now it's going to mess up our whole retirement plan. This money have to be invested and be left alone. You can't touch it. Don't touch it. Please don't touch it. Because in order for this to work, you have to consistently keep buying more shares. Buy and hold, buy and hold, buy and hold. Keep buying. Okay? Because this 120,000 turns into hold on, let me okay. So that's the factor. So I need a multiple. That's what I was trying to calculate. So your money will multiply 9 times, basically. Somewhere in there, about 9 to 10 times. So you sitting up there with 1.1 million in your Roth IRA because you listen to my videos, right? And you did what I told you to do. If you was to have this any other account, if you was to have this in a traditional, it don't matter if it was in a 401k or not, it's a retirement account. Okay? You got 1.1 million in the traditional, you're gonna have to pay taxes on this. Anytime you move money out of it, you're gonna pay taxes. And so let's look at the average person's tax rate. We're looking at 1.2%. We don't know what the tax is going to look like in 20 years from now. More than likely, it's going to be more than 20%. But say you paying say you paying 30% taxes. I mean, that's 300,000, man. You don't want to pay 300,000 in taxes. You don't want to do that. So it is best for you to put this money in the Roth IRA. That's what is best. It's best to do that. So that way, all the money that's growing, your 120,000 that whole time is growing up to the million, 1.1 million, 1.2 million, and you get ready to pull the money out. Pay the light bill, water bill, groceries, car notes, take your family on a trip, etc., 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 etc. I mean, you need consistent income. You don't have to pay taxes on it. Yeah. You don't have to pay federal taxes. You might still have to pay state taxes, but you don't have to pay federal taxes. And we don't like federal because federal, you talking about 20%. You got to pay the capital gains rate, and and so that's the point I was trying to get across with that. That's so even though I didn't have chat prepared, that's the point I was trying to get across. And it looks like after taxes, see, it got capital gains tax of 150,000. And that's what I was trying to explain. If you have this in a Roth IRA, you can get rid of that, and you will have your whole 1.1 million. You don't have to worry about paying capital gains. If you got it all in a Roth IRA, because all you have to do, you sitting up there 1.1 million, all you got to do is sell off QQQ, turn right back around and buy what? We was looking at SPY? SPYD, I think. SPYD, the high dividend growth S&P 500. All we got to do is turn around and buy another ETF, Spider, high dividend growth, and then that fund will spit out 53, well, because you go back in the video, $53,000. $53,000 a year. $53,000 a year. And that's just based on 20 years. Now, if you let it sit in there longer, if you let it sit in there for 25 years, 30 years, you be looking at a cool $70,000, $80,000 a year, man, easy in retirement. And we ain't even talk about Social Security. Combined with Social Security and this retirement strategy, man, we talking about a cool $100,000 a year in retirement. We talking about a cool $100,000 in retirement. I'll let that sink in. I'll let that sink in for y'all. I'll let it sink in. Let it process in your mind. Like, you could really be sitting at the house getting Social Security at 65. Social Security gonna run you about 25, 30,000. Say you sitting up there collecting $35,000 a year in Social Security and another $60,000, $70,000, $80,000 a year off your retirement account that I showed y'all how to build. You could be right around the neighborhood about $100,000 a year in income without working. Think about that. I'll let that sit in here. Some of y'all probably be making more money in retirement than you ever did while working. Some of y'all ain't never made more than $60,000. I'll let that sink in for a while. So, if you look at this chart, it's taking into account the expense ratio, which is for QQQ is 0.15%. And it shows you off 1.1 million, you looking at about $1,600 a year. And so forth. You know, I'll put these charts in the chat so y'all can look at them. So if y'all want to look at them for yourself, and you can just go down the list here and look at the different funds. Let me see. IWF is 890. Okay. Okay. So this chart here shows the after-tax income. So, okay, so this first row right here, QQQM, I think this amount is going to be more, because if you put it into a Roth, you don't have to pay taxes. But for the sake of this conversation, you're going from QQQM to SPYD, invested $973,000, and the account is paying 4.74% yield, and that account has a 0.07% expense ratio, and it looks like you are going to be getting about $46,000 a year in income. And then after tax, you got to pay the dividend tax. If it's a qualified dividend, you got to pay taxes on it. You can't really get around that. You'd be looking at anywhere between 10 to 15% qualified dividend tax. And it shows about $6,900 in taxes. After tax income, you be bringing home $39,000 a year, man. That ain't bad to sit at the house. That ain't bad. And like I said, long as you have your money invested in this fund, you're going to get this money every year, because the fund is based on strong dividend paying stocks. Chevron has been consistently paying a dividend for the last 40 years. So based on that information, I can kind of determine that I can rely on this for consistent income. A company that reliable, Coca-Cola, PepsiCo, Procter and Gamble haven't decreased their stock, haven't decreased their dividend. I mean, you talk about over 20, 30 years, man. Like, you know, you think about the average length of a job. Like, most people depend on a job, right? And you think how comfortable you are having this job. But you don't know your company could be going out of business. You don't know that. But you can have the same faith in one of these funds, knowing that, okay, your average ETF, mutual fund, index fund, is managed by competent people. Mutual funds, index funds, ETFs, they are required to have quarterly compliance reviews. So they're being audited, making sure that, the SEC comes in and audit these funds and making sure they're doing it what they're supposed to do. So if you worry about whether a mutual fund or ETF and you invest in your hard-earned money, you have to do the research, making sure that the fund is in compliant and taking care of their shareholders. That's what you have to do. So that way you feel comfortable. Because I know the average person, they're fearful of putting this money in there, and you don't know, and the price going up and the price going down, and you're scared. Should you take your money out? And like, no, man. These funds are backed by, you have to do the research to know that these funds that are backed by competent, respectful, honest, hardworking people. You have to figure out who the managers are. Research the managers. What are their what are their ethics? How often do these funds get audited? Who conducts the audit? Does the SEC come in? Are there government agencies? Do the mutual fund boards, the board of directors of the mutual funds and stuff like that? And so once you gather all that information, you looked at the rate of return, you can feel strong about betting on consistently investing your money into these funds. So that way, at a certain day and time, when you get 60, 65 years old, you're comfortable. You can stand high and say, okay, I'm going to have this money when I retire, and you can bet on it. And so you have to take that time and do the research on it. And so that's kind of one of the reasons why I'm putting this information out here, because I know a lot of y'all are truck drivers. I'm a driver. So I own the trucking business. Okay? And so I get it. You running up and down the road for 20, 30 years. Ain't nobody taking care of you. I'm providing you some information to make sure you good, making sure you taken care of. I need y'all to invest in this stuff so you can have you a good retirement. Because I know a lot of y'all don't have no pensions. Nobody ain't telling y'all how to invest and the science. Nobody ain't sitting y'all down. It's just, you got a bunch of people trying to take money out your pocket. Bunch of people trying to steal money out your pocket, and ain't nobody fighting for you. You just got to take the time and do the research on your own, and making sure that you got a good, stable program to set you up, so when you're in old age, you can sit down, man, and enjoy life. I don't want to go on this rant, but so if you look at this, it's got all these funds, right? And it's comparing basically when and where, you buy into a dividend fund. So basically on the left side where it's got starter, those are all the growth funds where you invested all those years, right? And then at some point, You switch gears and you take that money and you invest it into a dividend fund. You want the dividend fund to provide you consistent income, because the growth funds don't pay a dividend. You can do any research on any fund, QQQ, SPY, or anything like that, or S&P 500. A lot of those funds don't pay a good dividend to live off of. So you have to change gears. And then once you get to 20 years and get the fund up to millions or so dollars, you change gears and put that money into the dividend fund. And now the fund start to pay you a dividend that you can actually live off of and pay bills with. You do that, you don't ever have to sell any shares. You can just sit up there forever and just don't ever have to sell no shares. To me, this is a better strategy than just putting money into an S&P 500 and it just going. And then at retirement, you're going to have to sell some of your shares. You're basically burning down your golden goose. You don't want to kill your golden goose. You want to keep your golden goose so she can continue to lay eggs for you. And that's kind of a metaphor I'm using here. You want to take care of your golden goose. You want to take care of your golden goose and make sure she's healthy, make sure she's eating good and comfortable. So that way every month she give you money. You don't want to sell and get rid of your golden goose. You want to be able to keep your golden goose so she can just continue to lay eggs for you. You can go shopping, you can pay your bills, you can go on trips. I mean, for a lot of people, maybe $50,000 ain't a bunch of money for you. Maybe you don't need it, but I'd rather have it than not. I'd rather have it than not. That's all I'm saying. You know, I'd rather have it than not. So if you go down this list, you got all these different funds. And so if you're looking at it and you're trying to figure out what this chart is doing, that's what it's doing. Because I'm gonna put these PDFs in the description below the video, so that way you can see it and read it for yourself. So you got the yield, you got the dividend ratio, and then you got the gross income, and then you got the tax, and then after tax income, and then you got some fees. You got the dividend fees. These fees, you could probably write them off on your taxes, because the fund, they're going to send you a 1099-D. I think investment accounts, they send out 1099-Ds. I think they're 1099-Ds. And once you file the 1099-Ds, it should be somewhere on the form when you do your taxes where you get to write off these fees. Like this one. You see this one? IDV charges a 0.5% expense ratio. That's a lot different than SPY that charges a 0.07% expense ratio. And so if you look right here, it's a difference. See, 38,000 and 32,000. I would rather have the 38,000. That's why I did this, so y'all can see the difference. These fees add up now. When you talking about $1 million, they start to add up. You see how much is adding up? We talking about $4,800 a year in fees. So that's why you gotta look at the fees, man. Fees are very important. To be honest, a 0.5% expense ratio is pretty high. 0.5, that's pretty high. So basically, I'm just scrolling down real quick. Trying to see, make sure, okay. So it looked like the best combination here to get the most the maximum amount of money in retirement is gonna be going from QQQM to SPYD. That looks like the best combination. It may be some other funds out there, but I ran this in chat and I asked chat to give me the top 5 performing ETFs, the top 5 growth ETFs, and then the top 5 dividend ETFs. And this is what it gave me. This is what it gave me. You could probably do some research and probably do better than this, but for the sake of this video, I just wanted to show y'all and go over with y'all some strategies so you can have a good, fruitful retirement. That's it. Like all these videos out here, people talking about getting millions in a week, investing in Bitcoin. Don't mess with that stuff, man. Don't mess with that stuff. Don't say I ain't warn you. Don't say I ain't warn you. I'm trying to figure out how to get these questions up. Hold on. Let me get these questions. Or maybe I gotta move it over here. Okay. Okay. I don't know. Like I want to see what y'all saying. I can't. Okay. I'm sorry, y'all. I can't see. I don't know. I don't know what's going on. My bad. Let me see. I don't know what's going on. Maybe I gotta turn off. All right, well, I got an hour and 20 minutes on here. Anyway, I hope y'all got some useful information out of this video. I hope y'all got some useful information out of it. But anyway, I appreciate y'all watching my videos, man. I'll see y'all next time.